Hello everyone. Disclaimer. This video is for informational purposes only and is not a stock recommendation. I am not a SEBI-registered analyst. Please do your own research or consult a financial advisor before making any investment decisions. Have you ever wondered what makes a company strong? It's a lot like how we manage our own money. Imagine you have a big loan. Every month, a large part of your salary goes towards paying the interest, or EMI. This leaves you with less money for your daily needs savings, a small vacation. You feel stressed, right? Companies feel the same way when they have a lot of debt. A company with huge loans has to pay a significant amount of its earnings as interest. This is a fixed cost that must be paid, good profit or not. This pressure can be immense in tough times. Now think about paying off your loan. Slowly but surely, interest payments fall. Suddenly, you have more money at month end. Invest it. Spend it on things you love, save for a rainy day. You feel more secure and in control. Same with companies that reduce debt. They free up cash formerly used for interest. That freedom opens possibilities and can be great for investors. Isn't that an interesting parallel? Reducing debt, deleveraging, signals strength to investors. It shows disciplined management focused on resilience. Systematic debt reduction strengthens the company's foundation. It becomes less vulnerable to downturns or RBI rate hikes. For shareholders, that means less risk. So, which Indian companies have been on this amazing journey of cutting down their debt? Let's look at a few quiet champions. First up is Reliance Industries, oil and gas, retail, telecom. A few years ago, it took on significant debt to build Jio. Strategic stake sales in Jio, stake sales in Reliance Retail, a successful rights issue. Reliance drastically reduced its debt and transformed its balance sheet. Shareholders delighted. Next, JSW Steel. The steel industry is cyclical and capital-intensive. Building plants, modernizing plants. JSW has been on a mission to deleverage, strong cash flows during high steel prices, managing expenses wisely. JSW paid down a substantial portion of its debt. Vedanta Limited zinc, oil, aluminum, iron ore. Vedanta used operational profits to pare down borrowings, reducing interest outgo. More earnings flow to the bottom line and shareholders. DLF Ltd, a major real estate player. Real estate was once notorious for massive debt. DLF sold non-core assets, used proceeds to slash debt, focused on strong sales from projects, maintained financial discipline. DLF strengthened its balance sheet. Why exactly is having less debt so powerful for a company? The most immediate and obvious benefit is the reduction in interest expenses. Let's take a simple example. Suppose a company earns a profit of 100 crore rupees before paying interest and taxes. If it has to pay 40 crore as interest on its loans, its profit before tax comes down to just 60 crore. Now, if the company works hard and reduces its debt and its interest payment drops to just 10 crore, its profit before tax shoots up to 90 crore. This happens without selling a single extra product. This extra profit directly belongs to the shareholders. This increase in profit has a wonderful cascading effect. A higher net profit means a higher earnings per share, which is a key metric that investors look at. When the EPS of a company increases, its stock often becomes more attractive in the market. This can lead to a re-rating of the stock, where investors are willing to pay a higher price for each share, leading to capital appreciation. So, by simply fixing its financial plumbing and reducing the leakage of cash through interest payments, a company can unlock significant value for its investors. It's a clear path to making the business more profitable. Furthermore, a debt-light balance sheet gives a company immense flexibility, which is a huge competitive advantage. Imagine two companies in the same industry. One is loaded with debt and the other is debt-free. Suddenly, a great opportunity comes up. A smaller competitor is available for a cheap acquisition. The debt-free company can quickly make a move, using its cash reserves or taking on a small manageable loan. The indebted company, however, is helpless. Its hands are tied because it cannot afford to borrow more. Being debt-light means you can play offense when others are forced to play defense. This financial strength is also a massive advantage during tough times. When an economic slowdown hits, companies with high debt are the first to get into trouble. Their sales may drop, but their interest payments remain fixed, creating a huge cash crunch. They might have to sell assets at low prices or even face bankruptcy. A company with low or no debt can weather the storm much more comfortably. It can survive the downturn and emerge even stronger when the economy recovers, as its weaker, indebted competitors may have fallen by the wayside. Isn't that a powerful position to be in? While reducing debt is a fantastic sign of good management and financial health, we as smart investors must remember it's not the only thing to look at. A company might have zero debt, but if its sales are falling, it is not a good investment, is it? Debt reduction is one important piece of the puzzle, but we must look at the entire picture. We need to check if the company is growing its revenues. Is it selling more products or services year after year? Consistent growth is the primary engine of long-term wealth creation. Another crucial factor to monitor is the company's profitability, specifically its profit margins. Is the company able to sell its products at a good price? Are its costs under control? A company that is increasing its sales but making less profit on each item sold might be heading for trouble. We want to see healthy and, ideally, improving profit margins. This shows that the company has a strong brand, a competitive advantage, excellent cost management. Also, don't forget to look at the cash flow from operations. Profit is an accounting number, but cash is king.